And we are a treat today to call on my fellow Commodore, Charles McVean, to come to the podium. Charles is CEO of McVean Trading. His biographical material is in the packet before you. I remind you that the notepads that you have before you, please write your questions on those, and we'll pick them up and ask all the questions of our panelists when we conclude both of our presentations. And without further ado, Charles, I invite you to the podium, and we look forward to your presentation.
Thank you very much, French, for that kind invitation. French has invited me over here, and he's given me the assignment to present a 5-hour dissertation in 20 minutes. And I'm fully prepared to do that, but after having dinner with the gentleman last night where he asked a lot of tough questions, I'm considering asking you to perhaps recuse yourself as anything other than moderator in the Q&A, French. In fact, it got so tough last night, I had to drag out Michael Drury, our chief economist, to come in and weigh in on a few of the conversations. Michael, could you stand up there? In the understanding of China, we'll put Michael up against anybody in the United States. He's been to China 20 times in the last 5 years. We have 2 full-time guys on the ground. We think China is obviously the leading edge of developments there, the leading edge of a lot of investment considerations. I also have Mike Hanthorne with me. Here's Mike over here. Mike is as good a grain statistician and an economist as there is in the world, I believe. We're very proud to have Mike. Furthermore, he is a bona fide Arkansas Razorback. And so my credentials there, my niece, Beth McVean, played soccer for Arkansas and graduated, I guess, last year, and she was a good little player. And Coach Broyles was a friend of mine. So. And we trust we can, in the cattle business, we have a lot of good friends out at Texas A&M University. And we trust we can have the support of you Razorbacks in helping welcome Texas A&M to the Western Division of the Southeastern Conference. In fact, we're going to get a few of them started. We're going to get a plane load of them started down at Tuscaloosa, Alabama, Bryant-Denny Stadium, and we're going to show them what it's all about at the home of the last 3 national champions. The SEC, I mean, not just Tuscaloosa. But I also want to recognize Mark Brubner, who does a great job of representing me. Where are you, Mark? Mark has been far more effective. Mark lives in Heber Springs. He's been far more effective in representing McVean Trading Company in Arkansas than he ever was in trying to improve my golf game 10 years ago, which proved to be a hopeless cause. But anyway, moving on here. Our presentation will be about the long-term outlook for U.S. agriculture in a potentially promising yet increasingly complex and challenging global macroeconomic environment. The only thing certain is in our status as a great nation, we will not make as many mistakes in the next 5 years as we've made in the last 15. We're not going to get to play that again. We got to get smart. We got to wake up and smell the coffee. And I'll present a few of the reasons we believe that. Now, on the optimistic side, let me say this. We're over in Memphis. We're in the middle of the Mississippi Delta. Is that a microphone too? Here, sir. And so there are great reasons to be very, very bullish on U.S. agriculture, in an absolute, but also in a relative sense. It may be we'll be the best of the best, like the winner of a Kentucky Derby, or it may be the best, we'll be the best of the worst, like the best horse in the glue factory today. But there are a lot of fundamentally very compelling reasons to like agriculture. At the top of the list, when we talk about the emerging markets, we have to recognize, and I think Michael Drury and I agree about 20% of the time, and that's about all. But we would agree, China is the lead horse. A lot of the growth you see, for example, in Russia is a direct result of China increasing the demand for oil that feeds down into Russia and goes to the Russian oil companies, and then Putin, through socialistic redistribution programs, passes on some of the wealth to his people so he has some chance to stay in office. And that's kind of the way the game works around the world. But China is the lead horse. And we see in China the per capita GDP is, if you can see the chart here, the per capita GDP in China way behind. That's the what we got is the U.S. up at the top. Then we have two other major Pacific Rim developers, Japan, the blue line, Korea, the green line. China has finally managed to climb above the $3,000 per capita GDP, which is proved to be in many cases a threshold where better things begin to happen in the economy. And what we see is China, the high growth rates of China, the GDP is now up to, per capita GDP, now up to nearly $5,000 a year. As you cross into that territory, good things begin to happen. For example, a serious increase in automobile sales or production in China. As we move on, we then imagine on the next chart, we look at the South Korean GDP, and then we rebench China to, let's see, what is it? It's to the equivalent point where they cross 3,000. And if China GDP were to grow on the model of, let's say, the history of South Korea over the last 20 years, the demand for food in China would be almost beyond satisfaction. The analysis of agriculture is far different from most businesses. You've got to begin by asking, is there any data that means anything? China has no earthly idea how many hogs there are in China. Absolutely. They don't even know how many farmers there are in China. And so we always try to get down to something that's relatively hard numbers that we can work with. And in this case, we'd like to focus on soybean meal. Now, as you look at center of the plate protein consumption by humans around the world, it makes sense to drill down to the bottom of the food chain. There are two primary originators of protein in the world. One is the soybean, which is commonly called an oilseed, but it's different from all the rest of the oilseeds. It has a much higher protein content. So when we talk about human edible protein, it finds its beginning in many cases either with the soybean or the soybean's great and traditional competitor, the ruminant animal. So the cattle do not need soybean meal. The cattle produce their own protein in the rumen. As we will touch on briefly going forward here, the cattle population in the United States and in the rest of the world is sharply below where it has been in the past. So this will further has the potential to enhance the demand for soybean meal going forward, even beyond what it might have been otherwise. And so, but it becomes interesting as we look down here with the red line being Chinese per capita soybean meal consumption. Then we got the green line, which is Korea, and the blue line, which is Japan. And you look at these numbers and you say, well, that's not exactly what we would have expected. Why is Japan why is Korea so much higher than Japan? And which is the relevant model for trying to understand the U.S. going forward? And we see a very similar pattern in grain consumption, where Korea, from a grain consumption point of view, has substantially outstripped Japan. And this brings us to some intriguing numbers. In fact, French, you've now inspired us to do a whole new research project at McVean Trading and Investments, where we're going to benchmark a lot of this stuff. For example, I'll get to seafood in just a second. We're going to bench it all back to a soybean meal equivalent so we can put it all together and make sense. But as we try to understand the difference between South Korea and Japan, we see that meat imports are far larger in Japan than they are in South Korea, and they're minuscule in China. So as you think about this, you say, my goodness, for China to move up the food chain, they can either begin to import large quantities of meat, but with their propensity to want to put their people to work at all costs, the suggestion, once again, is their demand for protein out of basically the U.S. and Brazil might truly explode. Going on to the next chart, and this is a very important chart. Japan eats a lot of seafood. Japan is an island nation. South Korea has a much larger shoreline relative to internal area than China does. We can't break out aquaculture from caught in the ocean seafood, but no matter how we look at it, China doesn't have the prospect to have nearly the percentage of seafood in their diets that either Korea or Japan has. So as we look at this from a narrow agricultural supply and demand proposition, you say if China can grow anything like the previous precedents for major Pacific Rim developing nations like Japan and South Korea, under that scenario, if we can get that growth over the next decade or so, I'm going to have some very wealthy friends living south and west of Memphis, Tennessee. And we just hope they'll come into Memphis and spend a little money in Memphis. And we know we can count on them to do that when they got the money. So, but now the question is, what are the prospects for China to continue to grow over the next decade like they have over the past decade, but also to grow along the rates established by the previous major Pacific Rim developers? And now we go back, it's popular among the modern financial commentators to selectively quote John Maynard Keynes. To unselectively quote John Maynard Keynes said, "A favorable trade balance, provided it is not too large, will prove extremely stimulating, whilst an unfavorable trade balance may soon produce a state of persistent depression." That's not Charlie McVean saying that. That's the legendary John Maynard Keynes. And we believe that that statement is more or less a self-evident truth in economics that has largely been ignored by the leadership of this country over the last 15 years. And as we go on, we see serious issues in respect to the prospects for China continuing to grow over the next decade like they have over the past decade. China is very specifically outside the parameters defined by the precedent Pacific Rim developers in 4 major ways. In the first instance, it's their trade balance as a percent of GDP. And this is, once again, is a 5-year average. And we see in that 5-year average, they've been running a massive trade surplus, 5–6% of GDP, more than twice what we saw in Japan, even in the bubble years of Japan. And we see the counterpart to that huge trade surplus in Japan is in China is its primary victim, the trade deficit of the United States of America, which for reasons which we will discuss, in our opinion, is absolutely and utterly unsustainable into the foreseeable future. The second case in which China is totally outside the traditional model for a Pacific Rim developer is its massive percentage of fixed investment relative to GDP. And here Japan consistently, even when Japan was overinvesting in the bubble years, the blue line there, their investment as a percent of GDP was down around 30-some-odd%, which we see China up north of 45%. Now, what is that investment? It is first of all, if the Union Pacific Railroad decides to expand their capacity by 10%, Bob could probably tell you how much their capital investment would have to go up in the years they were trying to do that, but it wouldn't be any 10%. It'd be a massive number to expand that capacity in that way. That's what I think, Michael, is properly called the investment multiplier. Today's investment is a leveraged enabler of 4- and 5-year growth expectations. And so they've been plowing massive capital into facilities to facilitate their export machine, but also a second massive amount of capital into good old-fashioned, we all know what this is about in the United States of America, real estate speculation on a scale with no previous precedent on this planet. So that dog is not going to hunt forever either. But on the flip side of those things, now there's a positive aspect to this next chart. Here is personal consumption expenditures in China as a percent of GDP. If the Chinese leadership knows that they are confronted with a challenge, For reasons we're going to discuss further in a minute, they cannot continue to run an export and investment-driven model. They must make the far more difficult transition into a consumer-driven economy. Now, if that were to be the case, personal consumption expenditures, if you rebalance personal consumption expenditures in China from something like 40% of GDP to something like 60% of GDP, that's a massive new demand, all else equal, for something, and among that something is going to be protein food. So going on, perhaps the most heinous way that China is outside the model for the Pacific Rim developer is in the distribution of income within the society. This is measured by a number that economists call the Gini coefficient. And we see that Japan was consistently below 35%. A 1 on the Gini coefficient would mean that one guy had all the money. Is that right, Michael? That was kind of Chairman Mao's concept. He would be the most equal. But when you've got this kind of maldistribution, now here's an embarrassing, I left a line off this chart. And the line I left off the chart is the Gini coefficient for the United States of America. And right now, it's at levels last seen in the late 1920s and levels fully the equal of the numbers reported on China right here. Now, it doesn't take a genius to figure out if the money is too concentrated in one small percentage of the economy, the only way to grow the economy is through massive credit extension into the median sector of the economy to recycle the money. China at the moment does not have the domestic financial system in place to accomplish such an internal redistribution of the buying power. So one of the things we want to watch for in China is more and more conversation about liberalization of the domestic financial sector. That's a prerequisite to making things happen. So for all those reasons, now I'd like to focus not on the investment in China, not on the Gini coefficient, but on their enormous export-driven growth over the last 15 years. And I'd like to look at what that has done on the other side of the world to the United States, to the economy of the United States of America. And I'd like to make this comment. The United States of America is not one giant corporation. We are a nation. We are a great and geopolitically dominant nation. We are a democracy. To sustain these conditions, one prerequisite condition is we must be able to put our people to work. We're very involved in the public schools in Memphis. We got a real crisis over there. When we look on a national basis, we see that if you talk about African American male high school dropouts, about 1 in 4 of those guys are in the joint on any given day. This is absolutely unsustainable. The social cost to the nation is immeasurable. The surest way to keep them out of the joint is put them to work in a halfway decent job. The following chart, fortunately we have consistent data going back to the 1960s. The following chart measures total hours worked in the private sector in the United States of America compared to not last quarter and not last year, but compared to one full decade prior. And what we see, for those of you who are probably my age or older, and that's a problem some of us have, but we were there back in the ugly recession of the 1970s, and many more of us were there in the ugly recession in the 1980s. And interestingly, even in those two very dire situations at the time, you'll notice that total man-hours worked in the U.S. economy in both cases were around 10% above where they had been a decade prior. Now look at this miserable debacle we see here now, where employment in the United States of America fell as low as hours worked fell as much as 5% below where they had been 10 years ago. Now, yes, we pumped it up a little bit, and we're off the dead low, and we are creating some jobs right now, but those jobs are being created on the back of absolutely unsustainable fiscal and monetary policies, and should be viewed only in that context. There are no accolades deserved for the few jobs we've managed to create in the last year, given the expense of creating those jobs. So the caption under the chart says the greatest job job creation machine in history is obviously broken. Is this the beginning of the end of the American century? Fair question, looking at the data. We go to the next chart. The next chart is the U.S. trade balance as a percent of gross domestic product, once again looked at on a 10-year perspective. Now the next chart, if you'll hold on just a second, Mike, the next chart we entitled very simply, that's the whole story in a nutshell, folks, with whole spelled H-O-L-E. And I submit that there's no rocket science in the next chart. Go ahead. Here we see the trade deficit on a 10-year average, that being the red line, plotted against the job creation, the blue line. There's no rocket science there. The evidence, if you ask me, is utterly and completely irrefutable. How do we continue to persist in ignoring the cold, hard facts of the situation? When you run a trade deficit, one of the internal sectors of your economy has to be spending more than your income. We got this trade deficit started by the household sector, as measured by the red line, spending way more than its income till what? Spending like drunken sailors till they couldn't borrow anymore. And so at the Lehman event, the whole thing blew up. And there are those who would criticize Ben Bernanke and those who would criticize Obama. And what's the guy from Harvard up there? Summers. Okay, I won't criticize Obama and I won't criticize Bernanke. If you want to ask me about Larry Summers, we'll talk about him later. But if the government had not intervened on a truly massive scale, our sense is, ladies and gentlemen, the ship was going down, not part of the way, all the way down. So what happened is we had to sustain the aggregate spending in the economy. We had to completely trash the federal government's balance sheet. Next chart. And so all we did is substitute overspending at the federal level for overspending at the household level. And economists are largely in the business. I enjoy having this conversation with Michael Drury. I say, you guys are basically in the business of causing confusion. There's something to be said for simplicity. And in the next chart, we got two sectors of this economy that basically produce nothing. They're in the consumption business. So on the next chart, we look at the combined financial position, financial balance of the two consumption sectors of the economy, the federal government and the household sector. And what we see when we combine the two, there's been absolutely no improvement whatsoever in what we're doing. We're continuing to borrow massive, massive amounts of money to bring demand into balance with supply in the economy. Going ahead. Most confusion in macroeconomics results from a simple failure to distinguish between cause and effect, because the system has to balance, it has to flow. The question is what's causing what? And here we see the correlation between the consumption side financial balance and the trade deficit. Now, all we hear about in Washington is debt and the federal balance and this, that, and the other. I will argue with you that the underlying cause of all of our problems is the blue line on the chart, the trade deficit. Because if you begin to correct that against an established consumption level, you begin to grow organic income so you can support total demand in the economy without having to borrow the money. Go ahead. And this game is getting long in the tooth. This is U.S. consumption side debt as a percent of GDP, and we already see in Europe that there is an end to that game. Now, as we come back to talking about Bernanke and the Federal Reserve, super aggressive, untraditional policies were most certainly necessary. However, nothing in economics or politics occurs in a vacuum. The unintended consequences of the super aggressive Federal Reserve policies is the resulting complacency, and you see it when you meet with investors. Well, everything's going to be all right after all. And long-term bonds are super cheap, and somehow or another, we're going to muddle through this situation. That is baloney. We're digging the hole deeper. We've got to come to grips with this structural trade deficit and its counterpart, the financial deficits. Now, many of you might read Dennis Gartman, who's a very popular financial writer, and he's a hard-working guy, and he puts out a newsletter every morning. Dennis only sleeps 2 or 3 hours a day. He was our guest speaker at an event that Michael hosted here in Memphis last week. Dennis Gartman, in his heart of hearts, believes that trade deficits don't matter. He's an avant-garde, pure free market guy. But he's got a problem. He lives next to the Norfolk Naval Yard, and he's a big fan of the U.S. Navy. And so in the same letter, he can talk about the virtues of free trade and bemoan the fact that the size of the Navy is declining. So in my introduction of Gartman to Dennis the other day, which was a 15-minute introduction, and I finally, 8 minutes into it, I had to reassure Dennis that in fact I was in the process of introducing him. But all of that was a lead up to this chart that I presented to Dennis right before he got on the podium. In the course of history, there is a fairly consistent 30-year time lag between economic strength and military strength. My position is I grew up in the world grain trade. I was globalized before globalization was cool. My boss at the time, Ned Cook from Memphis, was the second man to ever fly into Russian airspace in a private aircraft, second only behind Arm & Hammer. I was with Louis Dreyfus Grain Company when the Chinese cut us into little tiny pieces on a bunch of boatloads of wheat we had in their ports, where after the wheat market had gone down by a couple of bucks, they managed to dig hard enough to find a couple of spores in there. They said, gentlemen, we're rejecting this wheat. And the loss back then was in millions and millions and millions of dollars. I speak now from the perspective of my 11 grandchildren and my long history being globalized. The remarkable success of the global economy in the last 15 years indeed resulted from an integration of the great virtues of Asia, specifically family values, work ethic, and willingness to take risk. The integration of those great strengths of Asia into the global economy under the rule of law imposed on everyone by a dominant Western superpower, the United States of America. If we relinquish that status, in some of your lifetime, you will see Asia revert to the laws of the jungle, in my opinion. They do not believe in the rule of law. So moving forward there. Now, meanwhile, back to the shop, it's great to worry about the future and this, that, and the other. Sometimes you have to make a buck, and some of you probably are afflicted to involvement in the commodity markets. Now, with that said, I adhere to what we call the Cargill philosophy. And the Cargill philosophy, and Cargill being one of the great privately held companies in the country, and I was trained by a lot of ex-Cargill people, the Cargill philosophy is that relative values are infinitely more understandable than absolute values. A good real estate man can forecast the value of lot A compared to lot B. The different value, he can say lot A is superior to lot B far more readily than he can forecast the value of those lots in 2 years' time. We now have in this country an absolute mania, a frothing at the mouth mania over growing corn. They are plowing this country up like you've never seen. And one good measure of that, one good measure of an investment mania is the sale of high-dollar Rolex watches. And I can tell you this winter, they were hauling Rolex watches from all over the United States of America into Des Moines, Iowa, to sell them to farmers who never dreamed of having a Rolex watch. Lost in the shuffle, now, Michael Hanthor said, surely you're not going to put all those numbers up there. Nobody will understand that. What those numbers are all about is to show how hard it is to figure out where all the corn that gets consumed in the United States actually go. And we're the only ones that have ever done these numbers. And once you do them, you arrive at a startling conclusion. Beef cattle in the United States of America eat more feed grain than all the hogs, chickens, and dairy cattle put together. And there are a whole lot of people out there not born knowing that simple fact. Go on to the next chart. The blue line is the feed grain consumption in this country, and the red line, which is a very proprietary model, is our model of grain fed to beef cattle. There may be some redeeming virtues to the ethanol program, but it sure came down at one great cost. The ethanol program largely destroyed the beef cow-calf industry in this country as we've always known it. And in the future, Michael had 5 Federal Reserve people at this meeting we had in Memphis last week, and my summary comment when asked what are the prospects for food inflation in this country, they said, "What do you think, Mr. McVean?" I said, "Fellas, you ain't seen nothing yet. Beef production in this country will collapse, and when it does, it's going to take domestic corn consumption down with it." Next chart. So about the time our boys up in Des Moines have got their Rolex watches and they probably got a bunch of Mercedes up there by now. And unfortunately, we've got very sophisticated weather consultants, but nobody can forecast the weather. If the good Lord lends a helping hand, we're going to make a corn crop this year that's going to be beyond the wildest imagination. And in spite of all the euphoria about corn, given those circumstances, if the creek don't rise, there will be a surplus of corn in the United States of America going into the new crop year. Next chart. Now back to our relative, now putting it all together a little bit, for those of you afflicted to risk-taking, we talked about the probable growing demand for protein in the world and the probable oversupply of corn. Interestingly, here in the December position, we see the price of soybean meal relative to the price of corn. This could be a huge, huge investment opportunity here over the next couple of years. Long soybean meal, short corn. I know I probably went over by as long as I was supposed to be up here to begin with, so I thank you for bearing with me.